Meghan, let's start with M&A, which is obviously my preferred subject. It's been very weak this year so far. Investment grade, on the other hand, has been very strong. Does that suggest a bit of a false dawn in the investment grade market?
Yeah, I think it's a fair point. I mean, a pretty remarkable start to the year, but some might say deceptively so, given it's really been front loading that drove January to the second most active on record. And that's in large part due to the fact that we're heading into a year whereby we're expecting supply to contract by as much as 5 to 10%.
And what drives that? Is that just the election and all of the uncertainty around that?
Yeah, I mean, there are two catalysts for the acceleration into the first quarter. One being the geopolitical overhang, the uncertainty around an unfolding election cycle. The other being, it'd be hard to miss the pretty sharp rally we saw in the month of December, whereby now we're back to spreads that are at pre-crisis tights within 20 basis points or so of where we were in March 2005, at a time where there's a pretty pronounced rate move lower. So it's a combination of the two, despite the fact that we're expecting tailwinds to sort of depress volumes as we move later into the year.
But we had this very strong 2019, particularly the first half in terms of deal activity here in the US particularly, but also in the rest of the world. The expectation was that we would go into 2020 and have a great first quarter because people would want to get stuff announced and out of the gates before the election really kicked into gear. That hasn't happened so far. Is that a worry for where the market is going to go the rest of the year?
Yeah, I mean, from an M&A vantage point, you look at historical election years. 4 out of the last 5 election years actually saw depressed M&A volumes as a function of companies trying to be a bit more reserved, not wanting to undertake transformative transactions in advance of having clarity around who that future leader might be, and the viability of those trades actually coming to fruition.
Another big trend that's been present in the market has obviously been US companies going to Europe to issue to take advantage of that sort of arbitrage opportunity. Is that something we're expecting to grow, or have we sort of topped out there?
No, a meaningful uptick in terms of the gravitation of U.S. companies to the European markets. You think about 20% of the transactions that came last year from U.S. companies in investment grade were actually in non-U.S. dollar denominated form. And the lion's share of that has been in the euro denominated markets. So much so that we saw a 4-fold growth in terms of dollar volume looking at U.S. corporates going to Europe. And that's continued in 2020. You had IBM do a transaction this week, Comcast as well, both upwards of $3 billion transactions. Dow has announced a marketing exercise for later this week as well. So there's a continuation of that trend. And I think given the relative yield disparity between those two markets, a theme that will stay with us throughout the entirety of the year.
Does Brexit and the sort of resolution of that process and some of the certainty that brings back to Europe more generally change the likelihood of that, as you say, that disparity between yields remaining?
Yeah, I mean, I think the more critical factor is the ECB continuing to underpin all-in yields in Europe. So if you're a U.S. company, you care about your optical coupon. On average, it's about 230 basis points lower than what you might achieve in the dollar market, despite the fact that we're at historic lows. So the arbitrage opportunity really is in place as a function of central bank maneuvering rather than as a knock-on effect of Brexit.
And what does the pipeline look like? I always ask that question whenever I have anyone in the deal space on here. It's what we're focused on.
Yes.
How does it look? What do you guys see as being most interesting going through the rest of this year?
Well, we were down 25% in terms of headline M&A volumes last year, and I hate to say that's probably the trajectory going forward as well. The pipeline is a good sort of forward-looking reference to what we might expect in 2020 from a financing perspective. And in the investment-grade markets, we're running at half the forward-looking pipeline at this stage that we were a year ago today. In large part because I think issuers are waiting to have clarity on the geopolitical front prior to making any outsized decisions.
We saw some very big financings last year and indeed in 2018 as well, some related to M&A, but some just people being very confident in the market. Are we expecting to see sort of similarly monster-sized financings this year?
I think they will actually be more measured-sized transactions, and a huge component of that is that the debt-financed piece of transactions are actually diminishing to a large degree as issuers tried to remain a bit more prudent around balance sheet management and leverage in particular. I know, sort of hearkening back to a year ago, there were a lot of concerns around the end of the business cycle and an outsized BBB component of the market. 4 of the top 10 M&A transactions last year were actually entirely stock funded. So the need to come to the debt markets and to over-lever has diminished fairly considerably.